Silver didn't just fall, it collapsed. Headlines screamed game over, screens bled red, and everyone was told the story was finished. But then something strange happened. While the West was panic selling, someone else was paying more, much more. Governments started flying people in, and an emergency meeting appeared on the calendar. Same week, same metal, same timing. That's not noise, that's a signal. Why this crash may not be what it looks like, and what happens next could change everything. Welcome to Market Metal. If you're watching this and you've seen a few cycles in your life, maybe stocks in the 80s, gold in the 70s, or markets in 2008, the real moves happen after the panic. And tell me this in the comments. The anomaly? A crash that triggered governments, not panic. The week silver collapsed was not a normal week in financial markets. It was not simply another correction, another bubble deflating, or another speculative excess being punished. It was a sequence of events that, when placed in proper order, raised a far more serious question. One that markets themselves could not answer, but governments appeared to be addressing quietly and urgently. Silver had just suffered a historic collapse. Prices fell roughly 41% in a matter of days, marking the worst decline in nearly half a century. Screens across trading desks turned red. Commentators rushed to explain the move with familiar language. Leverage unwinding, speculative excess, margin calls, and a crowded trade finally breaking. To most observers, the story seemed complete. A volatile asset rose too far, too fast, and reality reasserted itself. Yet something did not align. Within days of the collapse, the United States government scheduled an emergency meeting focused on critical minerals. Not a routine policy discussion, not a long-planned summit announced months in advance. An emergency ministerial-level meeting with international delegations flying into Washington centered on supply chains for strategically important resources. The timing was impossible to ignore. Governments do not convene emergency meetings because prices fall. They do not mobilize diplomatic and industrial coordination because a speculative asset corrects. Governments respond when access, continuity, or control of essential resources is at risk. And silver, whether markets acknowledge it or not, sits directly within that category. This contradiction formed the first anomaly. Public markets were behaving as if silver had become less important overnight. Policymakers were behaving as if it had become more important. To understand why this matters, it is necessary to examine what silver represents beyond price charts. Silver is not simply a monetary metal or a retail investment vehicle. It is a foundational input for modern industrial systems. Energy infrastructure, advanced electronics, medical technology, and defense systems all rely on silver's physical properties. Unlike financial assets, silver cannot be substituted easily. It cannot be replaced with software, derivatives, or efficiency gains. If silver supply tightens, production slows. If production slows, economic and strategic consequences follow. This reality creates a gap between how markets price silver and how governments assess it. Markets react to momentum, leverage, and liquidity. Governments react to supply risk and long-term dependency. When those two perspectives diverge sharply, price action alone becomes an incomplete signal. The silver crash revealed exactly such a divergence. In the days leading up to the collapse, silver had experienced an extraordinary rally. Prices had risen from roughly $30 in early 2025 to above $120 by late January 2026. The move was fast, steep, and increasingly driven by speculative flows. Momentum strategies, retail participation, and cross-asset capital rotation accelerated the rise. Volatility increased, particularly during Asian trading hours, where buying pressure repeatedly pushed prices higher overnight. By late January, the market was no longer trading primarily on industrial demand or long-term scarcity. It was trading on positioning. Gains attracted leverage. Leverage increased sensitivity. Sensitivity amplified reactions to any change in policy expectations or currency dynamics. That change arrived abruptly. A shift in expectations around U.S. monetary leadership and interest rate policy strengthened the dollar and altered the short-term outlook for precious metals. In highly leveraged markets, even modest macro adjustments can act as triggers. Once selling began, it cascaded. Margin calls forced liquidation. Liquidation pushed prices lower. Lower prices triggered more margin calls. The structure of the futures market turned a correction into a collapse. From a technical perspective, the mechanics were clear, but mechanics alone do not explain why governments moved immediately afterward. This is where the second anomaly emerged. While Western markets experienced panic, forced selling, and liquidity stress, signals from the physical market told a different story. Physical silver was not being abandoned, it was being absorbed, at prices significantly higher than those shown on Western screens. The divergence suggested that the crash reflected a breakdown in paper positioning rather than a collapse in underlying demand. For policymakers, this distinction is critical. Paper markets can unwind violently without altering physical realities. Futures contracts can be liquidated in hours. Supply chains cannot be rebuilt that quickly. When a crash occurs in a market tied to strategic materials, governments do not ask whether traders lost money. They ask whether supply security has been compromised. The emergency meeting on critical minerals was scheduled precisely within this context. Official statements describe the goal as strengthening and diversifying supply chains. In policy language, this phrasing carries weight. Strengthening implies vulnerability. Diversifying implies overconcentration. Together, they indicate concern about dependency, specifically, dependency on supply chains that may no longer be reliable in times of stress. Silver occupies a unique position in this framework. Unlike oil, it does not have a strategic reserve system scaled to modern industrial demand. Unlike copper, it is often produced as a byproduct, rather than as a primary target, limiting the speed at which supply can respond to price signals. Unlike rare earths, it is deeply embedded across multiple sectors simultaneously, making shortages systemic rather than isolated. From the government's perspective, a sharp price decline does not eliminate these risks. In fact, it can worsen them. When prices collapse, capital investment slows, exploration budgets are cut, new projects are delayed. For commodities with long development timelines, this creates future shortages rather than surplus. Governments understand this dynamic well. Many of the most severe resource crises in history were preceded by periods of price weakness that discouraged supply investment. This is why the timing of the emergency meeting matters more than the crash itself. If silver were simply a speculative excess being corrected, there would be no need for immediate policy coordination. The market would stabilize on its own. Instead, the meeting suggested that authorities were concerned not with price volatility, but with structural exposure. The anomaly deepens further when viewed alongside institutional behavior. Large financial institutions did not retreat from precious metals exposure after the crash. Instead, they adjusted geography and infrastructure. Strategic operations shifted closer to physical demand centers, settlement hubs, and jurisdictions where metal moves, not just contracts. These are not defensive actions taken during panic. They are preparatory actions taken when long-term trends are being reassessed. In this light, the silver crash appears less like an ending and more like a stress test. It exposed how quickly leveraged markets can disconnect from physical reality. It highlighted the fragility of price discovery when liquidity dominates fundamentals. And it forced governments to confront a question that had been building quietly for years: whether critical materials can continue to be left entirely to financial markets. For the public, the narrative remained simple. Prices fell, risk was punished. The story moved on. For decision makers, the narrative was more complex. A strategic resource experienced a violent paper liquidation, while physical demand held firm. Supply chains remained constrained. Industrial dependency remained unchanged, and geopolitical competition over materials continued to intensify. In such an environment, inaction carries its own risks. Part 1 establishes the foundation of the problem. A historic market event occurred, but its significance lies not in the losses it caused, but in the reactions it triggered. When markets panic and governments mobilize simultaneously, it signals a disconnect between perception and reality. The next step is to understand where that disconnect originates, and why the same ounce of silver can appear cheap in one market and scarce in another. The two markets. When one price lies and the other refuses to move. If Part 1 raised the question of why governments moved after the crash, Part 2 answers a more unsettling question: which silver actually crashed? On paper, silver collapsed. On screens, it was a bloodbath. Charts showed a violent breakdown, one of the worst in decades. Traders saw stop losses trigger, margins rise, and positions disappear in hours. To anyone watching only Western futures markets, the message was clear: silver had failed. But that message was incomplete and possibly wrong. At the exact same time Western markets were collapsing, another silver market was sending a completely different signal. Quietly, calmly, without panic, without headlines. That market was the physical market in Asia. This is where the story stops being about volatility and starts becoming about structure. There are, in reality, two silver markets operating at the same time. Most investors treat them as one. They are not. The first is the paper market. This is the world of futures contracts, leveraged positions, margin requirements, and algorithmic trading. Prices move quickly. Liquidity is deep until it suddenly vanishes. Most participants never touch a single ounce of metal. They trade promises, not atoms. The second is the physical market. This is where silver is bought to be used, stored, or secured. Here, delivery matters, inventory matters, access matters. This market moves slower, but when stress appears, it does not collapse, it tightens. The crash revealed how far apart these two markets have drifted. As Western silver futures plunged into the 70s, physical silver in Asia did not follow. Instead, it traded at a significant premium. Not a small one, not a temporary dislocation, a sustained gap approaching 30%. That number matters. A premium of that size is not noise. It is not shipping cost. It is not currency friction. It is a signal that buyers are willing to pay substantially more to secure metal now rather than rely on paper promises that may not deliver. The implication is simple but profound. The cheaper price may not represent true availability. In the Western futures market, silver is priced based on contracts that can be settled financially. Delivery is optional for most participants. When stress hits, positions are closed, not fulfilled. This allows prices to fall rapidly without metal changing hands. In the physical market, the opposite is true. Metal must be sourced, moved, and delivered. When demand rises or supply tightens, prices do not collapse, they resist. During the crash, this resistance became impossible to ignore. Data from Asian exchanges showed that while Western prices were collapsing freely, Asian markets hit limits. Trading was paused, contracts were locked, not because buyers disappeared, but because price controls were triggered to slow activity. This is a critical distinction. Western markets were falling because sellers overwhelmed buyers. Asian markets were being restrained because buyers overwhelmed sellers. That inversion tells a story no chart on a retail trading app will show. To understand why, it helps to examine how price discovery actually works. In theory, global commodity prices should converge. Arbitrage should eliminate large gaps. If silver is cheaper in one market, buyers should purchase there and sell where prices are higher. But arbitrage only works when the asset is freely transferable and reliably deliverable. When delivery risk enters the equation, arbitrage breaks. During the crash, paper silver was abundant. Physical silver was not. This is why the premium persisted. Buyers in Asia were not reacting to price charts. They were reacting to availability. They were securing supply in an environment where trust in paper settlement was declining. The futures price said silver was cheap. The physical market said silver was scarce. Both cannot be true at the same time. This divergence exposes a deeper issue, price discovery failure. In healthy markets, prices reflect the balance of supply and demand for the underlying good. In distorted markets, prices reflect the balance of leverage and liquidity instead. When leverage dominates, prices can fall even as demand remains strong. That is exactly what occurred. The crash forced leverage participants out of positions. Margin hikes accelerated the process. As contracts were liquidated, prices fell rapidly. None of this required physical silver to flood the market. It required only that paper exposure be unwound. Meanwhile, industrial users and long-term buyers did not stop purchasing. In fact, many increased purchases, taking advantage of dislocation. They were not reacting emotionally, they were executing procurement. This behavior creates a dangerous illusion for observers who look only at futures prices. It makes a strategic material appear weak at the very moment it is being accumulated. This illusion matters because governments and institutions do not rely on futures charts to assess risk. They rely on flows, premiums, inventories, and delivery behavior. And those indicators were flashing warnings. One of the most telling signals came from exchange controls themselves. Asian exchanges imposed limits, suspended funds, and restricted trading activity. These actions were not designed to support prices. They were designed to prevent instability caused by excessive demand. When regulators step in to cool buying rather than stop selling, it reveals where pressure truly exists. Western markets had no such breaks. Selling was allowed to cascade freely. Margin requirements rose into weakness, accelerating liquidation. The system did exactly what it was designed to do, protect clearinghouses by forcing participants out. But protecting the system does not mean protecting supply. This is the core tension at the heart of the silver market. Paper markets are optimized for financial stability. Physical markets are optimized for material continuity. In times of stress, these goals diverge. The crash forced that divergence into the open. From a strategic standpoint, the most alarming detail was not the size of the price drop. It was the persistence of the premium. Even after the initial shock passed, even as prices rebounded modestly, the gap remained elevated. This suggests that physical buyers did not view the crash as a reason to step back. They viewed it as confirmation that paper prices could no longer be trusted as indicators of supply health. Confirmation that access mattered more than valuation. Confirmation that silver was becoming a procurement issue, not a trading instrument. Once that shift occurs, the role of futures markets changes. They stop being discovery mechanisms and start becoming volatility engines, useful for hedging, dangerous for signals. This is where suspense enters the story. If two markets price the same metal differently for extended periods, one of them must eventually adjust. Either physical demand weakens and premiums collapse, or paper markets reprice upward to reflect scarcity. History suggests that when industrial demand is inelastic and supply is constrained, paper markets adjust, not the other way around. This is why governments were watching physical indicators, not futures charts. They saw premiums holding. They saw inventories tightening. They saw buyers willing to pay more in the middle of a crash, and they understood what that meant. The crash did not destroy demand. It revealed where demand truly resides. Part 2 leaves the audience with an uncomfortable realization. The silver market did not speak with one voice during the collapse, it spoke with two. One screamed panic, the other whispered urgency. In part 3, the story moves from markets to institutions. Because when large actors stop listening to prices and start moving infrastructure, it signals that the whisper has become loud enough to act on. The silent repositioning. When institutions move before the narrative breaks. If part 2 exposed the existence of two silver markets, part 3 reveals something even more unsettling: who adjusted their position before the public realized a shift was underway. Markets talk loudly, institutions move quietly. While headlines focused on collapsing prices and forced liquidations, some of the most powerful actors in global finance were doing something very different. They were not debating whether silver was dead. They were deciding where they needed to be when the market's center of gravity moved. This is where the story leaves price charts behind and enters the realm of strategic positioning. Large financial institutions do not respond to volatility the way traders do. They do not react to daily candles or social sentiment. When they make changes, those changes are slow, expensive, and deliberate. They involve people, infrastructure, regulation, and long-term capital commitments. Such moves are rarely made for short-term reasons. That is why what happened next matters. One of the largest and most influential banks in the world quietly shifted its precious metals operations away from traditional Western hubs and toward Asia. Not an expansion, not a satellite office. A relocation of core activity into the heart of the region where physical demand was strongest and premiums were rising. This decision did not occur after the crash. It had been prepared in advance. Institutions do not move operations overnight. Regulatory approvals, staffing transitions, technology migration, and counterparty arrangements take months, sometimes years, which means the decision to move was based on data gathered long before prices collapsed. This creates a critical question. What were they seeing before everyone else? To answer that, it helps to understand how institutions think about commodities differently from traders. For a trader, silver is a position. It is a line on a screen, a source of return or risk. For an institution involved in physical markets, silver is a system. It involves sourcing, storage, settlement, transportation, and counterparty trust. When any one of those components becomes uncertain, the entire system must be reevaluated. The signals prompting reevaluation were subtle but consistent. Physical premiums in Asia were not just rising, they were becoming persistent. Delivery times were stretching. Inventory flows were tightening. Central banks were increasing exposure to tangible reserves. Industrial buyers were seeking long-term supply agreements rather than spot purchases. None of this showed up clearly in futures prices, but it showed up clearly in operational data. This is the type of information institutions prioritize. They do not ask whether an asset is overbought. They ask whether access will still exist under stress. From that perspective, the Western silver market was beginning to look fragile. Futures markets function smoothly when confidence in settlement is high. When participants trust that contracts can be fulfilled, leverage expands and liquidity deepens. But when stress reveals that most participants have no intention of taking delivery, the market's function changes. It becomes a venue for risk transfer, not resource allocation. Institutions saw that change happening in real time. As volatility increased, margin requirements rose. As margins rose, leveraged players exited. As they exited, price signals became increasingly detached from physical reality. This made futures prices less useful as indicators of true supply-demand balance. At the same time, Asian markets, particularly those closer to manufacturing and industrial consumption, continued to transact at higher prices. Not because of speculation, but because the metal was needed. This divergence forced a strategic decision. If the future of price discovery was shifting toward physical settlement and demand-driven markets, institutions needed to be positioned where that discovery occurred. Geography matters in commodities. Being closer to consumption hubs, refineries, and logistics networks provides informational and operational advantages that screens cannot. This is why the move east is so significant. It signals a belief that the marginal buyer of silver is no longer setting price in New York or London. It signals that the most important signals now originate where metal is delivered and used, not where it is traded most heavily on paper. Once institutions reach this conclusion, they act, quietly, before narratives catch up. This pattern is not new. Historically, major shifts in commodity markets have been preceded by institutional repositioning. In energy, trading desks moved closer to physical hubs as supply chains globalized. In agriculture, firms integrated logistics and storage when volatility increased. In metals, control over refining and delivery has always mattered more than futures volume. Silver is now following that path. What makes this moment different is timing. The repositioning became visible only after the crash, but the decision preceded it. This suggests that the crash was not a surprise to those watching physical indicators. It was anticipated as a likely outcome of excessive leverage layered on top of constrained supply. From an institutional standpoint, the crash may have served a purpose. It flushed speculative excess. It forced weak hands out, it reduced noise, and it created an opportunity for long-term accumulation under less crowded conditions. This does not mean institutions caused the crash. It means they were prepared for it. Preparation is the clearest sign of conviction. Another signal reinforcing this view came from capital allocation patterns. Rather than exiting precious metals exposure, long-term capital shifted how that exposure was structured. Less emphasis on short-term price bets, more emphasis on physical access, storage, and supply agreements. This is not retreat. It is refinement. For governments and institutions alike, the question is no longer whether silver prices can be volatile. That is accepted. The question is whether reliance on paper markets introduces unacceptable risk when access to physical supply becomes critical. This question is particularly urgent in an environment where geopolitical fragmentation is increasing. Supply chains are no longer assumed to be global and frictionless. Strategic autonomy has become a policy objective. Materials once treated as commodities are being reevaluated as assets tied to national resilience. Silver sits uncomfortably at this intersection. It is essential to modern technology, difficult to substitute, slow to supply, and widely distributed across industries. That combination makes it strategically sensitive. Institutions understood this before the crash made it obvious. They watched physical premiums hold while futures collapsed. They watched buying pressure persist under regulatory restraint. They watched industrial demand remain inelastic, and they adjusted their positioning accordingly. The public, meanwhile, was shown a different picture. They saw prices falling and assumed importance was declining. They saw volatility and assumed fragility. They were not shown the quiet movements happening beneath the surface. This gap between perception and preparation is where suspense builds, because when institutions reposition quietly, it is rarely the end of a story. It is the midpoint. Part 3 establishes that the crash did not push strategic actors away from silver. It pulled them closer to where silver actually moves. The infrastructure shift suggests a belief that future stress will occur not in prices, but in access. In Part 4, the final piece comes into focus: why governments, not traders, ultimately determine how this story evolves, and why silver is now being treated less like a market asset and more like a matter of national security. The strategic reckoning. When markets end and policy begins. By the time the emergency meeting appeared on the U.S. government calendar, the silver crash had already done its damage. Traders had been liquidated, leverage had been flushed, screens had gone red and then quiet again. To most of the market, the event was over. For policymakers, it was just beginning. Governments do not respond to price action the way markets do. They respond to vulnerability. And what the silver crash exposed was not weakness in demand, but fragility in the system responsible for supplying a material the modern economy cannot function without. This distinction is the key to understanding why the final chapter of this story does not belong to traders at all. It belongs to policy. Silver occupies a unique and uncomfortable position in the global resource hierarchy. It is not rare enough to be treated like a specialty metal, yet not abundant enough to be ignored. It is consumed, not recycled, efficiently. It is essential across multiple sectors at the same time. And critically, it is not mined primarily for itself. Most silver production occurs as a byproduct of copper, zinc, and lead mining. This means supply does not respond quickly to silver prices. Even dramatic price increases do not immediately produce new output. Mines cannot simply turn on silver production in response to demand. The supply curve is slow, rigid, and largely indifferent to short-term price signals. For governments responsible for energy systems, defense infrastructure, and industrial continuity, this is a structural problem. In 2025 alone, global industrial demand for silver reached approximately 680 million ounces. That demand did not go into vaults or ETFs. It went into solar panels, electrical contacts, medical equipment, communication systems, and advanced military technology. Once used, it was gone. At the same time, global mine supply failed to keep pace. The gap was filled not by new production, but by drawing down existing inventories. Year after year, stockpiles quietly shrank. This is not a sustainable equilibrium. Markets can ignore this imbalance for long periods, especially when paper trading dominates price discovery. Governments cannot. When inventories fall and supply cannot respond, dependency becomes visible. And dependency, in a fractured geopolitical environment, becomes a strategic risk. This is the context in which the emergency critical minerals meeting must be understood. Official language framed the goal as strengthening and diversifying supply chains. In practical terms, this implies recognition that current arrangements are insufficient. It implies concern that access could be disrupted by geopolitical tension, export controls, financial instability, or market dysfunction. Silver is particularly exposed to all four. Unlike oil, there is no strategic petroleum reserve equivalent scale to modern silver consumption. Unlike semiconductors, there is no concentrated manufacturing base that can be rapidly subsidized. Unlike rare earths, silver is embedded everywhere, making selective prioritization difficult. In such circumstances, governments have a limited set of tools. They can stockpile. They can incentivize domestic production. They can restrict exports. They can form bilateral supply agreements. They can designate materials as strategic and remove them from purely financial circulation. None of these actions require prices to rise first. In fact, historically, they often follow price weakness, precisely because weakness discourages private investment and accelerates long-term scarcity. This is where the crash takes on a different meaning. Rather than signaling the end of silver's relevance, it may have accelerated its transition from a market asset to a policy concern. Once a material enters that category, the rules change. Policy-driven demand does not behave like speculative demand. It does not chase momentum. It does not panic sell. It accumulates deliberately, often quietly, and over long time horizons. This is why the recovery that followed the crash matters. Silver did not drift lower for months. It did not grind downward as capital abandoned the space. Instead, it stabilized and rebounded sharply. Gold followed a similar pattern. These are not the behaviors of assets whose fundamental demand has evaporated. They are the behaviors of assets where forced selling exhausted itself and real buyers stepped in. Those buyers were not retail investors reacting to headlines. They were industrial users securing supply. They were institutions adjusting exposure. They were entities whose decisions are governed by necessity, not sentiment. This dynamic exposes the core flaw in the mainstream narrative. The crash was interpreted as a verdict on silver's value. In reality, it was a verdict on leverage. Speculative excess had built on top of a tight physical market. When the excess collapsed, it created the illusion of abundance. But the underlying constraints did not change. Mines did not suddenly produce more metal. Industrial demand did not suddenly disappear. Strategic dependency did not diminish. The crash removed participants who were never going to take delivery. It did not remove those who need silver to operate. This distinction mirrors historical precedent. In the 1970s, gold experienced violent corrections that convinced many the bull market was over. Each time, speculative participants exited. Each time, the structural drivers remained. Those who understood the difference between price volatility and structural demand were ultimately proven correct. Silver's situation today is arguably more complex, not less. It sits at the intersection of energy transition, technological expansion, and geopolitical competition. Each of these trends increases reliance on physical inputs that cannot be easily substituted or rapidly scaled. In such an environment, market signals become less reliable as guides to policy reality. The most important developments occur not on charts, but in meeting rooms. That is why the emergency meeting matters more than any single candle on a price chart. It signals recognition. Recognition that leaving critical materials entirely to financial markets may no longer be viable. Recognition that access matters more than valuation. Recognition that the future of silver may be decided less by traders and more by governments. This realization creates discomfort because it implies a loss of control for market participants. If silver is increasingly treated as a strategic resource, its availability, pricing, and flow may be influenced by considerations that have nothing to do with short-term returns. Policy decisions can override market logic. Stockpiles can absorb supply. Restrictions can fragment markets. Paper prices can diverge from physical reality for extended periods. This does not guarantee higher prices. It guarantees complexity. And complexity is precisely what the crash revealed. The final suspense of this story lies not in predicting what silver will do next, but in recognizing what has already changed. Two markets have diverged. Institutions have repositioned. Governments have mobilized. These are not reactions to a dying asset. They are responses to an asset whose importance has outgrown the structures used to trade it. The silver crash was real. The pain was real. But crashes do not destroy strategic value. They expose who misunderstands it. In the end, the most important question is not whether silver survived the crash. It is whether the market framework surrounding silver can survive the shift that is now underway. That question does not have an immediate answer, but the actions taken in the days following the collapse suggest that those closest to the data are no longer waiting for the market to decide. They are preparing for a future in which silver is not just traded, but secured.